Ladies and gentlemen, good day and welcome to Q1 FY26 earnings conference call of Elecon Engineering Company Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. Please note that this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Mayank Bhandari from Asian Market Securities. Thank you, and over to you, sir.
Good evening, everyone. On behalf of Asian Market Securities, we welcome you all for the 1Q FY26 conference call of Elecon Engineering Limited. I take this opportunity to welcome the management of Elecon Engineering, presented by Mr. Kamlesh Shah, Group CFO, Mr. Narasimhan Raghunathan, CFO, along with their team. Now I request Kamlesh Shah to take us through the overview of the company quarterly results, and then we shall begin with the Q&A session. Over to you, Kamlesh.
Good evening and very warm welcome to everyone on our Q1 FY26 earnings conference call. I am joined today by my colleague Mr. M.M. Nanda, Head of Gear Division, Mr. Deepak Talwari, Head Designate of Gear Division, Mr. Kaushik Patel, Head of MHE Division, Mr. Narasimhan Raghunathan, CFO. The press release and investor presentation have been uploaded on the stock exchanges as well as our company website. I hope everyone has had the opportunity to go through the same. To begin with, I'll provide a brief macro level overview of the prevailing business environment, followed by a detailed review of our financial performance, which Mr. Narasimhan, our CFO, will take you through. Elecon Engineering is a leading manufacturer of gear solutions and material handling equipment, recognized for its innovation, superior quality, and dependable performance. Serving a broad spectrum of industries, including steel, cement, sugar, power, and marine, we are dedicated to delivering customized, best-in-class solutions that drive operational efficiency and growth. As one of Asia's largest suppliers of industrial gear solutions, Elecon holds a leadership position in India's organized gear market. Our global footprint spans approximately 95 countries, supported by a robust distribution network and long-standing relationships with key industry players. In line with our strategic vision, we aim to increase the share of exports to 50% of total revenue by FY30. This ambitious global expansion is powered by our strong R&D capabilities, continuous investment in product innovation, and strategic partnership with OEMs across international markets. Our business is anchored by two divisions, industrial gear and material handling equipment, each playing a distinct role in shaping our overall performance. The gear division, which contributed approximately 73% to our consolidated revenue in Q1, delivers a steady performance during the quarter, with a growth of 6% in revenue on a year-on-year basis. The momentum shows some softness in Q1 is due to in terms of product deliveries, especially in Middle East markets. We have also seen some impact of geopolitical volatility in some overseas markets during the quarter. Having said that, we do not foresee any material impact on the business from a full year perspective. We have shown our resilience in FY25 also, where we have overcome comparatively more muted momentum in the beginning of the year, but we ended on a very strong note. Compared to last year, the demand momentum currently is relatively better. We have received robust orders during the quarter and encouraging by the sustained inquiry levels, which bodes well for future order inflows. The division is well positioned to build on this momentum, supported by improving market sentiment and ongoing capital investment across key industries. Along with steady momentum in the steel and cement sectors, we are seeing very strong growth coming from power sector this year. In Q4 FY25, we capitalized our new manufacturing facility in gear division. While this marks a significant step towards enhancing our capacity and long-term growth, it has had a short-term impact on margins in Q1. This is due to accelerated depreciation without corresponding revenue contribution from the new facility. As we ramp up production and begin generating revenue from this new capacity, we expect the margin in the gear division return to normalized level. Coming to the MHE division, we continue to deliver consistent, robust performance. On a reported basis, revenue has increased by 139% YOY. This includes one-time amount of around rupees 25 crores from arbitration claim settlement of previous contracts which we have recognized as revenue in Q1. Even after adjusting this amount, our revenue has nearly doubled on a YOY basis in this quarter. Our strong performance is supported by a healthy order book, driven largely by sustained demand from the power and cement sector. We are also witnessing encouraging order visibility in the steel segment, reflecting broader industrial momentum. MHE division continues to demonstrate a strong growth trajectory driven by the successful execution of our strategic initiatives, increasing market demand, and our proven capabilities to deliver customized solutions across diverse industries. Looking ahead, we remain confident in division's continued momentum, supported by a healthy order book and robust demand outlook across the key sectors. All in all, the current order backlog and momentum of the order inflows across both our divisions provide a strong foundation and visibility for healthy growth in the coming quarters. Elecon remains strongly focused on executing its long-term growth strategy. We are actively diversifying our business portfolio and expanding our presence across new sectors and international markets. Our wide-ranging product portfolio, backed by strong in-house R&D and engineering capabilities, continues to differentiate us in the industry. Our ability to deliver customized, high-quality solutions positions us well to meet the evolving and complex needs of our customers. The MHE is on the robust upward trajectory and emerging as a key growth driver for Elecon. In the gear division, inquiry level remains encouraging. We are seeing consistent demand from both domestic and international markets. Also, there are some geopolitical headwinds in some of the overseas markets. The traction is quite steady on an overall basis. We are seeing a positive outlook in the defense industry and expecting to receive orders in the later part of this year. We take pride with the way we have executed and delivered in the last year. During the challenging macroeconomic environment in the earlier part, we displayed great resilience and discipline. As the external environment improved, Elecon showed its ability to capitalize on the same, and we ended FY25 on a very strong footing. Looking at the order inflow momentum continues to be consistent. Together with the current order backlog, it provides a good foundation and visibility for sustained momentum and growth in the coming quarter. With this, I would like to hand over the call to Mr. Narasimhan, our CFO, for financial highlights for Q1 FY26. Over to you, Narasimhan.
Thank you, sir. Good evening, everyone. A very warm welcome to our Q1 FY26 earnings call. I will now take you through the highlights of our financial performance for the quarter ended 30th June 2025. We are pleased to report a resilient performance for Q1 FY26. For the quarter ended June 2025, our consolidated revenue from operations stood at rupees 491 crores compared to rupees 392 crores in Q1 FY25, reflecting a healthy growth of 25% on a year-on-year basis. This has been driven largely by strong growth in the domestic business activities across both divisions, which has also been aided by a favorable base. In the overseas business, we have faced some geopolitical-led headwinds in Middle East market. Nonetheless, the inquiry levels in most overseas markets remains encouraging. Domestic demand too is picking up meaningfully, particularly from core sectors of power, steel, and cement. The consolidated revenue for Q1 FY26 includes rupees 25 crores pertaining to arbitration settlement for some of the earlier contracts in the MHE divisions, which has been recognized in the current quarter. The domestic market contributed 75% to the consolidated revenue, while the remaining 25% come from overseas markets. Our domestic revenue in Q1 FY26 stood at rupees 367 crores compared to rupees 259 crores in Q1 FY25, reflecting a growth of 41.4% on a year-on-year basis. Our overseas revenue in Q1 FY26 stood at rupees 124 crores compared to 133 crores in Q1 FY25, reflecting a decline of 7% on a year-on-year basis. The order book visibility and continuing inquiry levels keeps us optimistic for higher growth in the coming quarters. Our consolidated EBITDA for the quarter was rupees 130 crores, up from rupees 92 crores in Q1 FY25, representing a growth of 41%. The EBITDA margin for the Q1 FY26 stands at 26.6% compared to 23.5% in Q1 FY25. After adjusting the one-time arbitration settlement income, EBITDA for Q1 FY26 would come to rupees 105 crores compared to 92 crores in Q1 FY25, reflecting a growth of 14% year-on-year. Adjusted EBITDA margin would come to 22.6% versus 23.5% in Q1 FY25. The consolidated EBITDA margin has been impacted by the increased cost in the gear division, which was driven by employee cost together with brand building initiatives undertaken in the overseas markets. As our recently commissioned capacity ramp up and benefits from the above initiatives in the overseas markets in terms of revenue starts to come in, we expect the margin to return to a normalized level. At a consolidated level, we expect to maintain an EBITDA margin of 24% on a steady state basis. Apart from rupees 25 crores recognized in the revenue, we have recognized another 10 crores pertaining to the arbitration settlement under other income as well during the quarter. In Q1 FY26, we have also recognized rupees 80 crores as an exceptional income. This pertains to the unrealized mark-to-market on reclassification of our investment in Elecon India Limited from associate to a financial asset. The profit after tax for the quarter, including this one-time income, comes to rupees 175 crores. Segment-wise performance. The gear division accounted for 73% of the total revenue in Q1 FY26. For the quarter ended June 2025, the gear division's revenue stood at 357 crores compared to 337 crores in Q1 FY25, up by 6% year-on-year. The EBIT for the gear division stood at rupees 66 crores in Q1 FY26 compared to 80 crores in Q1 FY25. The EBIT margin declined to 18.4% in Q1 FY26 compared to 23.7% in the same quarter last year, mainly due to the increase relating to employee cost and brand building initiatives undertaken in the overseas market. EBIT margin was also impacted by accelerated depreciation on the new manufacturing facility, while the corresponding revenue has still not come in. The order intake for the quarter was rupees 480 crores, reflecting a healthy 21% year-on-year increase. As at 30th June 2025, our open order book stood at rupees 710 crores, positioning us for a sustainable growth in the upcoming quarters. The material handling equipment division delivered another outstanding performance in Q1 FY26, including the arbitration settlement income. The MHE division's revenue for the quarter was 133 crores compared to 56 crores in Q1 FY25, growing by 139% year-on-year. Excluding the one-off income, revenue growth would have been at 93.6%. This growth is driven by a strong demand in both the product supply and the aftermarket segment across the core end-use sectors of power, steel, and cement. The EBIT for MHE stood at 61 crores compared to 14 crores in Q1 FY25, reflecting a significant growth. After adjusting for the arbitration income, the EBIT would have grown by 155% year-on-year. The adjusted EBIT margin stood at 27% in Q1 FY26, up from 25.3% in Q1 FY25. This was primarily due to a favorable product mix and a higher contribution from the aftermarket business. The order inflow for the quarter stood at rupees 134 crores compared to 149 crores in Q1 FY25. As at 30th June 2025, the open order book for MHE stood at 400 crores, reflecting a strong demand and growth prospects. On the balance sheet front, we are pleased to report a strong net cash position of around 550 crores, providing us with significant financial flexibility to pursue growth opportunities and maintain operational resilience. Looking ahead, the capital expenditure budget for FY26 to FY28 is rupees 400 crores for the next 3-year period. On that note, I would like to open the floor for questions you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vishal from Bandhan AMC. Please go ahead.
Hello, good evening. Thank you for the opportunity. The first question is on the exports and the international business side. Could you elaborate exactly what happened, what led to the decline in exports of 7% on a year-on-year basis?
This was due to some hold of deliveries for the goods in the Middle East because of Israel and Iran war kind of situation, and the delivery will get there by in the Q2 sometime.
How big would have this been? I mean, what would
14
be the
crore.
approximate quantum?
14 crores.
That's it. So, even if I adjust for this 14 crores, we would have still reported a decline in the exports revenue.
Yeah, that momentum will come up by Q2, Q3.
Are we seeing any weakness in our core geographies, say UK, Europe, or in any other geographies that we are?
In fact, this time UK and Europe both have did better way, particularly compared to the Q1 last year.
Okay. So which are the other geographies that would have been weaker for us? I mean, because you've reported 124 crores of exports. Even if I adjust for 14 crores, you would have still reported a decline. So that is what I'm trying to understand.
Yeah, what I said, one is a 14 crore the delivery deferred to Q2, as well as some orders are on hold also in the Middle East.
Okay. The other question is on the order inflow of 480 crores in the gear business that you've reported. What portion of these orders would have come from the international side? International business?
The MHE division, no?
No, for the gears business.
Gear business, yeah. What's that? 119. Yeah. So 119 crore is the order from overseas business.
And this is what sort of growth on a year-on-year basis?
So this is the growth. I should go on what the revenue of this quarter plus the future for the rest of the period.
I was trying to understand this 119 crores of order inflow that you've got from the international business for gears. This is a growth of what percent?
Yeah, one.
On year-on-year basis?
Yeah.
Yes, sir.
It is 10%.
10% growth.
10% growth. Okay. And last question is on the profitability. You said that higher manpower cost and operational expenses of the new plant have impacted the margins in the gears business. So by when do we see normalization of profitability here?
I think by the end of the year, we'll sustain our margin what we already spent on.
So when you say that we should have 24% margin for the gears business, we should be about at the same level, 24-25%?
Further, this margin is also because of the change in the product mix also. Generally, my product mix between the engineer product and the standard product is 50-50, 50% plus in the engineer product. For Q1, my revenue from engineer product is 43% and 57% from the standard product.
Okay.
Generally, if you compare on a quarter-on-quarter basis, this change will be there. But by the end of the year, it is getting covered up.
Indeed. All right. I'll come back in the queue. Thank you.
Thanks.
Thank you. The next question is from the line of Pratik Khotari from Unique PMS. Please go ahead.
Yes, good afternoon. So first, this Middle East order, the delay, this would be from the international subsidiaries, right? The delay that you spoke about, not from India to export.
But ultimately, it is going from India to Dubai or directly to the customer, as the case may be, depend upon what the order says about the delivery schedule and how the delivery is to be done. But the order is from Middle East, and because of this current geopolitical challenges between Israel and Iran, which also is getting escalating. So the customer has put the hold on the delivery for this period, and he is going to get in the queue to some time.
Correct. And of this ROU assets which we had capitalized last year in Q4, I mean, so everything is now capitalized, and what we see in interest and depreciation is now fully accounted for.
Some part is there. It is of nearly 25 crore, which is getting capitalized in Q2 sometime.
Okay, which will come subsequently.
Yeah.
Okay, fair enough. And sir, on this arbitration now, all of this past arbitration is behind us. I mean, after this order which we have.
Whatever we did, whatever we committed, we realized. I think we realized better than that also.
Yes.
But still now we have initiated further 2 arbitration proceedings, and which we are expecting. One of them will get the outcome will come by end of this year, and another will come in the next year sometime. Where we are expecting 20 crore plus in terms of the realization.
Correct. Fair enough. And so this 400 crores of capex for next 3 years, including this one. I mean, some light. Where do we intend to spend this? What will be the where is it? And this will be again on the route of ROU, or will we be taking it on a balance sheet? So 2 questions here.
So this will be at both the ways, because some part will be at our own and some part we will go with an ROU, because this is more beneficial to us. Because I see as a long-term benefit to the organization rather than the short-term.
Correct. And where will this spend be? I mean, this 400 crores, how do we intend to spend?
That will be over the period of 3 to 4 years. So what will I will spend, but some part may come in the 4th year also, depend upon this.
Yeah, I understand. My question was, where do we intend to spend? I mean, on what? Is it specific in gear, somewhere in international?
400 crore will be in the gear division. And over and above this 400 crore, for 35 crore we are going to spend in MHE division also. Because my MHE division is also getting the momentum. That the 35 crore of MHE will come in this year, whereas the 400 crore of gear division will be spent over the period of 3 years.
Correct. Great. Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, could you give us some update on the domestic business, how it has been growing, and which sectors have contributed to this growth? That's the first question.
So growth is coming domestic. If you say the domestic market, we are quite positive and robust about the domestic market, because that momentum is continuing, you can say for the last couple of years, and that will further continue for the next couple of years also. Now this year we are seeing the momentum from steel, cement, and the power sector is also giving the boost to us. So recently only we get an order for nearly 80 crore from the power sector itself. And we also are going to see a good momentum which is going to come in this year from the defense sector also, because defense sector, I think we are expecting anything in the Q2, a small thing, but the big one we can expect any time now, because everything is being geared up for, and we are quite positive for that.
And sir, any tentative size you can say? Will it be like 500 crores or so for the defense part, sir?
See, we are expecting, close to 200 crore this year, and next year we are expecting a better numbers, as we go further on that.
Understood. And by H2, do you think this margins would mainly move towards 24-25% range, or it will start reflecting from Q2 onwards, sir?
This will be there from Q2 onwards. You can see that momentum of 24% margin.
Okay. And sir, the capex which you mentioned, which is largely for the gearboxes. So which sector are we going to see more of these gearboxes being, specific? If you can share something. Is there anything also for the high-speed gearboxes which you are already trying to enter into? If you can give some clarity on that.
All our machines are, general purpose machines. It is not for a specific line or for the specific sector or for specific customers, unlike in the automobile sector. So this will be for the across the sectors and across the applications over there, including for the high-speed gear. But we are mainly gearing up ourselves for our export market, where we see a good momentum is coming up from the OEM business, and we have to keep ourselves ready for any kind of volume which we are estimated to work for.
Okay. Thanks. And sir, last question on the MHE segment side, sir. The margin this quarter has been the highest over last few quarters. What is a sustainable margin that one thing we can expect, and any number you can suggest for MHE for the full year basis? What is the number that we can expect?
Full year, I think we already spell out. MHE is expected to generate a revenue of 650 crore for this year. That is year ended March 31st, 2026. And what we see that 23% is sustainable margin that we already see. When I say 23% is over in a period of next 2 to 3 years. That is it. So any change in the product mix are improving the my margin. That 23% is conservative figure, which what we say is minimum achievable for us. Any good product mix which are giving a better revenue margin for us in MHE.
Okay, and just sorry to add one more question, sir. We started also exports business in the MHE. Can you share some update on where are we on that, and are we going to see more traction on the export side for MHE as well, sir?
Okay. Yes. As we told last year, we secured one order of export that is of 1.4 million, and that has been successfully executed in last year. And yes, we have a focus on export, and we have ample inquiry from the overseas market. In fact, we are expecting one order in coming quarter in Q2. That amount is near to 1.8 million USD. So going forward, export is our focus area, and we are going to create our footprint in the global market as far as MHE business is.
And also,
sorry?
Yeah, go ahead, sir. Go ahead.
Yeah. In fact, we are also expecting one good order earliest in Q4 of this financial year and quarter 1 of next financial year. Amount is near to 12 million USD.
Oh wow, that's a large order. And our stance on we taking only the product part of MHE and not the complete EPC also stands for exports as well, right? So the orders which we are talking of.
Yeah, we did the same strategy what we have adopted since 2017. So we are focusing on supplying of the equipments and of course after sales market.
Understood, sir. Okay. Yeah. Thank you very much for understanding.
We have very clear business strategy to just go for the supply of equipment only and after sales. Now, we don't want to explore further in turnkey projects anymore.
Fair enough, sir. Thank you very much and wishing you all the best.
Thank you.
The next question is from the line of Mithili Balakrishnan from Alchemy Capital Management. Please go ahead.
Hi. Couple of questions. I wanted to check with you on the OEM business. You had mentioned that last year we had done around 60 crores in FY25. What is the momentum you're seeing in that business currently?
That is a momentum which is keeping us busy, and that is the reason we are quite confident, and that is how we are putting our capex plan also. I think Nandaji would be the one who can just provide more also.
You see, basically we have supplied some of the prototypes in the past, and then we also started receiving the serial production, on this basis. And as we projected last year, it was 1 million,
6 million that way.
6 million we got it against that, And going forward also we are quite a robust situation on that. And we expect almost 2 million now.
In this Q1, we generated the revenue of 2 million euro, and by end of this year, we are confident to generate nearly 7 million euro of business for us.
Got it. In terms of our, guidance of 2650 crores of revenue, this does not include the 25 crores odd of arbitration that we have.
No. It is only revenue what we have projected, normal business revenue.
Got it. In terms of depreciation, if I remember in the last call, you had mentioned that there should be in a 70 to 75 crore run rate for the full year, FY26. But clearly we are running ahead of that, and it possibly is closer to 100 crore. Would that be the right number to look at?
For all, at the console level, the depreciation would be at that level, of that year. As far as for this year, my depreciation by end of the year would be nearly 90 crore for gear division.
And for the overall company, it will be closer to 100 crores, right?
Yes. 100 and 105.
Okay. Got that. Also, in terms of the inflows to the MHE division, it seemed a little weak this quarter. So I just wanted to get a sense, is that some seasonality to the business, or is it, anything else to read into that?
In MHE, yes, we were expecting certain order to come in Q1. That has been now coming in Q2. In fact, we already secured few orders in July itself, in the last 10 days. So I think whatever gap is generated in Q1 comparing to last year, Q1, I think that has been covered up now. And going forward, there is a good traction in the MHE business from cement, steel and power.
Got it. That's all from my side. Thank you. Thanks a lot for this.
Thank you. The next question is from the line of Raj Shah from Enam AMC. Please go ahead.
Am I audible?
Yeah, you're clearly audible.
Yes. Hi, sir. So my first question was regarding the brand building activities and increasing employee cost, which led to lower margins in this quarter. If you can explain where this cost was spent, in which areas, and what was the quantum?
That amount is spent in the Europe mainly, where we are just working more on the digital platform and engaging the service of the consultant over there also for the brand building. And employee cost, yes, it is because of the normal increment, plus we also increase some employees, so which also has there also. The quantum of, I don't know the actual quantum of how much we have spent in this Q1 and what is our target to spend in that for the full year also. But that is as per our plan what we have just spelled out earlier also.
Okay, got it. Another question was on borrowing cost. There was an increase Last year, same quarter, it was 2 crores. This year, it was 6 crores. So I was just trying to get the sense what it could be for the entire year, because as per March 25 balance sheet, our borrowings have increased.
No, borrowing, it's not the borrowing, but what we have did, we also discussed earlier at the various forums. We have acquired the machinery and we did the capex under an operating lease. So considering the Ind AS as applicable, this is to be divided into two parts. One is on account of the principal amount and on the interest portion also, which is called the discounting, based on the discount. So discounting part is getting reflected as a finance cost, and the principal amount is reflected as depreciation also. Okay. It's not a borrowing, but it is the division of the lease amount over the period of 5 years between principal and discount as per the Ind AS standard.
Got it. And around 25 crores, I guess you said it is yet to be capitalized, which will be in Q2.
Yes, it will be capitalized in Q2. We just received the machine in June sometime, and it is under installation phase.
Oh, got it. And sir, with this new capex getting commissioned, what will be our revenue potential?
Additional revenue with this 300 crore capex, what we did over the period of 3 years, it is going to generate additional 500 crore of revenue for us.
Okay. Thank you, sir. That answers my question.
Thank you, Raj.
Thank you. The next question is from the line of Neeraj Mansinga from White Pine Investment. Please go ahead.
So, thank you very much. I just wanted to know one small thing. You spoke about 11, 12 OEM customers in the past. Can you just give an overall color on, I know you've got orders on that, but can you give an overall color on of these orders, how many are fructifying and how much are still work in progress, prototype, etc.?
So now as on today, our number of OEMs are 18. So they, of which some are under the development, which is there also, and most of them are now started the commercial production also. That is the series production.
So when do you see this larger scale up for them happening if the commercial started?
That larger scale will start, you can say, from January 2026 onwards.
And what can be the run rate? Any thoughts on that? And I know it's speculative to some extent, but any color on the range that it can go on per customer basis?
So with the current geopolitical scenarios, which is there in the Western countries as well as the Middle East level, and particularly on the western side of Asia, presently it becomes very challenging part. But this year we are going to generate 70 crore of revenue from these OEMs. If all things get normalized, then I think we are quite sure it will generate 100 crore plus of revenue, at the potential for us also. At the first phase level, what we see. Going forward, the same will generate more revenue by adding more product portfolio in our basket, or we may also explore the new opportunities from the other OEMs also.
Okay, got. Thank you for the color.
Thank you.
The next question is from the line of Lakshmi Narayan from Tunga Investments. Please go ahead.
Thank you. Just a few questions. First is that what is the revenue mix from spares and refurbishment in the gear section? And do you actually offer on-site refurbishment, or you actually do the refurbishment at your sites, at your own location?
Yeah, because I think we are not. I think your voice is not clear.
Is it
so you're talking about refurbishment? You're talking about refurbishment?
Yes.
So my question is that what percentage of our revenues in gear is actually coming from spares and refurbishment? And then whether we offer on-site refurbishment, or you actually bring the gear at your location and do the refurbishment?
Yeah. So far the numbers are concerned, for this quarter, Q1, from our revenue, we have generated 32% from service.
CSDN.
So, service, which includes both breakdown services or spare parts plus refurbishment also. Regarding the on-site and off-site, I think Mr. Nanda who will just give us.
See, normally, if we say small adjustments are to be done, we do it at the site, but, if the major refurbishment is to be done, the gearbox comes to our refurbishment center at Vallabhidanagar and, Madurai, actually. And that's how we normally work on that.
Got it. And do you see a potential of this refurbishment even in international markets? Because I'm told that refurbishment is a large market and it is slightly under-penetrated. If my assumption is right, what is your plan on this? Because it seems to be a large market.
Yes, you are right. Refurbishment is a huge market which is there. So we already planned last year and we already have placed one full-fledged service team at the USA. We also are going to explore the same to have the setup in further expanding the setup in the Europe also.
Got it. And you had mentioned there is a heightened capex in sectors like cement, steel, and power. Just want to understand, in particular, domestic market in US. May I know how long is your capacity booked on these things? And second, do you actually see it continue for a longer time, which is 2 to 3 years? These 3 or 4 sectors you actually mentioned.
Generally, we get the order which is executable within a period of 6 months. When it is a customer or the engineer product, it is there. So booking and all the customers knows very well, about our delivery capabilities. Accordingly, they place the order. We also don't place the order very much in advance also. They place the order. So, and we have a clear visibility for next up to 2027. We have a very clear visibility of the order inflow as well as the execution of the order and the revenue visibility.
This is for the domestic sector.
Domestic. And also we have the same clear visibility, but in overseas market, considering just started the pace for the OEM market, we don't know how it will get, it will accelerate and take the larger space in the market considering the geopolitical scenarios.
Okay. One last question from my side. What percentage of revenues are contributed by products where only you have the capability to make and others don't have in your gear division or maybe material handling division?
So in the gear division, if I say more specifically, it is on account of the engineer product, where we have very less competition and up to some extent no competition. And particularly if you see the capability on account of the defense side, we don't foresee any competition so far in India in domestic markets are concerned. So whatever competition is coming, that is only coming from the overseas market.
Got it. Thank you, sir. I will get back in queue.
Thank you.
Thank you. The next question is from the line of Nirmam from Unique PMS. Please go ahead.
Yeah. Sir, on a TV interview, we mentioned, we can grow for 25% CAGR for the next 3 years. So according to which segments would drive this growth? I mean, we have a lot of businesses. We've added a new segments. We're working on new things. So what would be the major driver of growth for this 25%?
Growth is coming from the overseas market in the gear division. As well as now we also are focusing on overseas market for the MHE division also. And MHE division also is coming very confidently for its growth trajectory. The overseas market for the OEM, then the gear also and MHE also, as well as the normal businesses from in the gear division, both in domestic as well as the overseas market.
Okay, sir. Yeah. Thank you.
Thank you. The next question is from the line of Akash from Dalal and Brocha. Please go ahead.
Yeah, thanks for the opportunity. Sir, firstly, I just wanted some clarification on questions asked by earlier participants. So, regarding CapEx, so I think we were planning around the 200 crore CapEx last year, of which 150 was spent on the P&L. So the balance 50 should reflect in this year's P&L, plus how much can we expect in FY26, the CapEx?
Overall CapEx in FY26 will not be more than 100 crore. Overall.
Okay. And you also spoke about possibility of winning a defense order. So that order amount, if you could quantify, did you allude to 200 crore for that defense order?
There are various opportunities are there in the defense sectors. What we see in the Q2, we are expecting an order of nearly 200 crore. The large order for the P-17, and now the new version which is called the P-17 Bravo, which we are expecting and which is going to come. Maybe it may come in the Q4 or maybe in the next year sometime.
And any ballpark guess on what would be that order value or worth?
That we are estimating it will be 1,000 crore plus order.
Okay. And all of these defense orders will be executable in one more than 12 months, 12 to 18 months kind of a time frame, right? Or even more than that.
The 200 crore which we just said, which is said will come by Q2 sometime, which will be executed over the period of 2 years, and that the big order which we are expecting maybe by Q4 or the next year sometime, that will be executable over the period of 3 years, as per the delivery schedules.
Understood. And you also mentioned about some recent win in the power sector of 80 crore. So that was on the gears or MHE side?
This is on gear side. So we are seeing the same momentum also will be there in the MHE also.
Understood. And sir, you mentioned about, so I think our total export book is around, overseas business is 124 crore. So out of that, can you give us a split of how much is overseas and how much is export from India?
Yeah. The 43 crore is export from India, and the remaining from the overseas area.
Which will be produced and produced or assembled in overseas and will be delivered over there.
Understood. And sir, if you could help us with the sector breakups, I mean, which you give every quarter, like how much of our revenue this quarter would be from power, cement, steel, for the top 3-4 sectors?
So what I'll do, Akash, I'll forward an email to you giving the entire picture of that.
No worries, sir. And sir, one question from the strategy standpoint. So I think last quarter we mentioned that we'll be opening certain assembly centers in US. So to enhance our business there. So I mean, what's the progress on that?
Presently, we have worked out an alternatives for that to accelerate. Rather than I will put my own entity over there, we have worked out how we will outsource over there by taking at least the marketing efforts from our side. So that we are still waiting about the outcome of the tariff from the US, which will help me to become more clear and specific on that.
Sir, my last question on MHE. So sir, MHE orders we have seen from the last 3-4 quarters, they have been increasing. This is the first quarter wherein the orders have been slightly declined. And also secondly, this quarter we have done such high margins in MHE, approx almost 33%, even if we exclude the arbitration award. So how much is the service component to the business? These two things I'd like to understand.
So if I give the answer for the first, the quarter-on-quarter comparison of the order flow and the revenue, I think so far our sectors of the company, the sectors in which we are there, it will not be there. Even earlier also I was talking the same on the various forums. Not to compare us with a quarter-on-quarter basis, that I think will not be the right approach. That's all. The margin is high is what you said, yes, this time it is high, but there is a one-off item of the revenue is nearly 25 crore. If you remove that, our margin profile is 27%.
So how much would be the service or replacement component to it? I mean, because of which the margins are so high?
The service component in this quarter is 41% in MHE sector.
Understood, sir. That's helpful, sir. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Mayank Bhandari from Asian Market Securities. Please go ahead.
Yeah, thanks for the opportunity. So just wanted to understand the MHE business segment performance once again. So we have clocked in almost revenue of 133 crore, which includes 25 crore of arbitrage income. Is it?
Correct.
And this also includes, so what is the net margin we have clocked in here in terms of EBIT?
In terms of absolute value or in terms of percentage?
Percentage.
In terms of percentage, 27% in MHE division we clocked the mark for this quarter.
Okay, and for the full year we are guiding how much then?
What we say the full year 23% sustainable margin, because we don't know how the revenue mix will perform over the period of time. But we generally have always delivered better margin on that.
On the gears segment, how are we seeing offtake or the orders in the engineered segment, particularly vis-a-vis standard? Is there any mix change in this quarter which is resulting in very sharp decline in the margin?
So this quarter, there's a sharp decline in the gear division on account of two. One is the product mix. So this quarter we did the standard product sales of 57%, and engineer product we did the revenue of 43%. That is one. Second, whatever we did, and second, the impact is on account of accelerated depreciation.
Okay, apart from the depreciation, so what is the normal mix or the standard mix we should assume here?
Generally, more normal mix is the engineer product is 50% plus anytime. It may be between 50 to 55% over there. So once that, I think that will start from Q2 onwards. So for the engineer products are concerned.
So margin will improve from...
Yeah, sure. And what we said, the yearly the margin profile for gear division, which is 25% maybe, I think it is achievable for us.
Okay, sir. Thank you.
Thank you. The next question is from the line of Divyanshu Kumar from Craving Alpha Wealth Fund. Please go ahead.
Thank you, sir, for the opportunity. So, first question is, how do you see competition evolving in India industrial markets, especially with the new entrants, if any?
Yeah, competition generally will be there, but whosoever the new entrants are coming or existing players who are coming out with an additional product profile. However, it is going to be a highly engineered product is there, which is required high skill. Though one can add the new machines and the new technology, but absorbing the technology and using the machine at the optimum level also is taking its own time to reach to a certain level.
Thank you, sir. So my another question is, with India's rising defense capex, what's the Elecon's target for defense as of total percentage of total gear division revenue by any future year?
In terms of the revenue, we can't execute the project which is coming, which are executable over the period of 2 to 3 years or sometimes maybe 5 years also. And we see a good traction is coming in defense sector, particularly Indian Navy. You might have heard about the recent developments on the strengthening the Indian Navy considering the challenges. So we see a good traction, and that is also we are betting upon a lot on this defense sector for Indian Navy or defense products.
Thank you, sir. Thank you for answering my query.
Thank you. Ladies and gentlemen, due to time constraint, this was the last question for today's conference call. I now hand the conference over to the management for closing comments.
Thank you. In closing, I would like to thank you all for joining this call and for your continued support to Elecon Engineering. We are encouraged by the steady momentum across both our gear and MHE division. Our consistent execution, focus on high growth segment, and disciplined approach to cost and capital allocation position us well for sustained performance, and we remain confident in our ability to build on this momentum, strengthen our market leadership, and continue delivering the value to all our stakeholders. And we will continue to focus on maximizing value for our shareholders. Thank you once again for your participation and trust in Elecon Engineering. If you have any further questions or inquiries, please do not hesitate to reach out to our Investor Relations Advisor SGA or our CFO Mr. Narasimhan Raghunathan or Mr. Ashish Jain, our Investor Relations Officer. Thank you.
Thank you. On behalf of Elecon Engineering Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.